Okay, so for the last couple of years, we've all been watching this absolutely explosive surge in AI stocks. It's a rally that has completely reshaped the market, creating just a staggering amount of wealth, and of course, sparking a huge debate. So that leads to the big question we're tackling today. Are we witnessing the dawn of a legitimate new tech era, or are we just watching another massive bubble inflate right before our eyes?
Just to wrap your head around the scale here, look at this number, $5 trillion. That's the market cap NVIDIA hit in 2025, and it's the first company in history to ever reach that milestone. This isn't just normal growth. This is a phenomenon, and it's driven almost entirely by the world's insatiable hunger for the hardware that makes AI possible.
So, yeah, that brings us right back to the central question of this whole explainer. Is this incredible run-up justified by a genuine technological revolution that's going to change everything? Or is it just a classic speculative frenzy, fueled by hype and easy money and doomed to end in a crash just like so many bubbles we've seen before?
To even begin to answer that, we've got to first understand the sheer scale of this boom. And let me tell you, the numbers are just staggering, unlike almost anything we've ever seen before.
And here's what's really wild. It's how concentrated all this growth is. Get this, an estimated 75% of the S&P 500's entire growth between 2023 and 2025 came from just 7 companies. The other 493 companies in the index, they accounted for just a quarter of the gains. This is not a broad market rally where everyone's winning. No, this is an AI-powered rocket ship, and only a tiny handful of companies are on board.
Now that kind of intense focus, that crazy speed, well, it's got a lot of analysts really worried. It's starting to look a lot like manias we've seen in the past. And that brings us to the first big argument, that we are, right now, living through a classic speculative bubble.
The parallels to the dot-com bubble are just hard to ignore. In both cases, you've got this huge narrative about a technology that's going to change the world. You had a period of easy money and low interest rates that just poured fuel on the fire. And of course, you get these explosive vertical run-ups in stock prices for any company with .com or now .ai in its name. The historical echo is loud.
And look, this warning isn't coming from some random analyst on the sidelines. This is from Sam Altman, the CEO of OpenAI, the very company that basically lit the fuse on this entire frenzy. When one of the architects of the revolution flat out says people are going to lose money, you gotta pay attention. And if you look around, you see all the classic signs. I'm talking about company valuations that have just completely detached from what they're actually earning. Venture capitalists are throwing billions at startups at, quote, mind-boggling prices. And we're even starting to see some, let's say, questionable financial setups like something called circular financing. Okay, let's break that down because it's a really important piece of the puzzle. Imagine a huge tech company invests, say, $100 million into a little AI startup, but then the startup immediately turns around and uses that exact same money to buy cloud services from the big tech company that just invested in it. The money literally just went in a circle. It creates this illusion of real organic demand, but in reality, it can be a self-feeding hype cycle that masks how fragile things really are.
But hold on, that's only one side of the coin. There's a really strong counter-argument that says nope, despite all the hype, this time it is fundamentally different. So let's dig into the case for a justified, sustainable boom.
And the key difference really pops out when you just look at the hard numbers. Let's talk valuations. At the peak of the dot-com bubble, top tech companies were trading at something like 70 times their expected future earnings. Today, the big AI players are closer to 26 times. Now don't get me wrong, that's still high, but it's not even in the same universe of crazy. Plus, the funding source is totally different. It's less about speculative IPOs and more about reinvesting actual profits. But honestly, the biggest, most critical difference is this: profitability. Back in 2000, only about 14%, 1/4, of tech companies were actually making money. The rest were just burning through cash on a dream. Today, the companies leading this AI charge, your NVIDIAs, Microsofts, Googles, they are absolute cash printing machines. And this really gets to the core of the "this is a real boom" argument. This isn't a party funded by hope and risky loans. It's an infrastructure build-out that's literally powered by profits. The world's most successful companies are using their own massive cash flows to build the future, and that makes the foundation today a whole lot stronger than it was back in 2000.
So, which is it? A dangerous bubble or a justified boom? Well, as you can probably guess, the truth isn't that simple. The reality is way more nuanced. And to really get it, we need a new way of looking at this whole thing.
And that brings us to this really fascinating idea, the inflection bubble. So the theory goes like this. Yes, there's absolutely a speculative bubble happening, but it's happening at the same time as a genuine world-changing technology shift. The speculation, while it's risky and definitely unsustainable, is actually like a necessary evil. It's the rocket fuel that's accelerating the whole revolution.
Okay, so to really see how this works, we've got to slice the AI market into 3 distinct layers. Think of it like a cake. At the bottom, you've got the infrastructure layer, the companies making the chips and running the data centers. In the middle are the foundational models, the big AI labs creating the large language models. And at the top, you have the applications, the actual tools and software that we use.
And here's the kicker. The risk is totally different depending on which layer you're in. Down at the infrastructure layer, companies are super profitable, but there's that risk of circular financing inflating things. Up at the application layer, you might have revenue, but often a poor return on investment. The real, true epicenter of the bubble risk, it's that middle layer, the foundational models. These guys are burning through billions of dollars with valuations that are just completely untethered from reality.
And just to show you the risk up at that top layer, get this. A recent study from MIT found that a staggering 95% of businesses that have built their own custom AI tools are not making their money back. There's this huge gap between the investment hype and the actual value businesses are getting right now.
So, where does all this leave us? Well, understanding this 3-layer structure is really the key to navigating the paradox of the AI market, a real revolution that's all tangled up with some very, very real speculative risk. So here's the bottom line. The AI revolution, it's not a mirage. It's absolutely real. But that bubble we're all worried about isn't spread evenly across the whole market. No, it's hyper-concentrated in that middle layer, the companies that are burning cash like there's no tomorrow, with astronomical valuations based entirely on a promise of what they might do one day, not what they're doing today.
Ultimately, that leaves us with one last big thought to chew on. The AI revolution is here, for sure. But if you look at the history of these things, not every company that starts the gold rush survives to the end. So the real question isn't if AI is going to fundamentally change our world. It will. The question is, when the inevitable shakeout comes, who's going to be left footing the bill for all the hype?